Let's do a course recap, and this is also sort of the concluding lectures. We are at the very end of this course. Hopefully, it has been a very good learning experience. We ended up covering pretty much every asset class in the financial markets, basically all the way from the starting point, which is stocks, and then we also went into derivatives and futures and options and forex and all of that. We also studied commodities. The best starting point, obviously, if you have not traded or invested before, you want to select one of these three, either stocks, ETFs, or mutual funds. That is the best starting point. Even to become an expert in options or futures, you have to at least have some idea of how stocks trade and invest. Even if it's on paper money, that's fine. You would want to start off there. Remember, commodities are generally very volatile, as we are seeing now with gold as well as oil. They can last a long time. Commodity markets are a direct indicator of the level of economic activity around the world. So when commodity prices are high, then economies are doing well. But now commodity prices are crashed in the beginning of 2016. So it is a indicator that things are really slowing down in the world in spite of all this money printing and all the pumping of this money into the economies. It's not really borne any fruit. So that is a concerning fact right now. Then next, I think you should follow news about the bond markets, inflation, and interest rates. And when I say follow, is whenever you see a headline, whenever you see a news piece on the TV, just pay attention to it. I mean, that's all you need. All you need to do is keep one eye and one ear on some of these matters. You'll realize that key market out of them all is the bond market, because that's really where smart money from all over the world is involved. Keep futures and forex for later, always, because these are anyway very highly leveraged and they're complicated stuff. And you want to learn options. You can combine options with stocks in very creative ways. You've already seen a couple of ways how you can do it. Position size is the ultimate killer. There's no question about it. If there's one statement that you want to take out of this whole course, is manage your position sizes appropriately. Like I said, if you have a $20,000 account, don't fill the whole account with Apple shares. And manage your losers. Manage your losers and the winners will come automatically. So whenever your loser hits a certain point, predetermined point that you have created, you need to do something with it. Whether it's hedging, whether it's cost averaging, whether it's buying some put options or buying some call options or selling some put options, whatever the case, there are many things that you can do, and you have to be aware of all those choices and make the right one. But if it reaches a certain point, you have to do something about it. So now I want to give this one slide where I want to explain some macro correlationships. So this, in general, these kind of relationships generally work. Now, occasionally something will break down, and that's when the markets are not in sync, and that's when there could be some opportunities as well as risks. First of all, the US dollar, as we know, is the global currency, and oil, gold, and all these commodities are priced in US dollars. So if the US dollar goes up, then the euro and all the other world currencies, including the pound and the yen and the franc, will go down in general, because the US dollar is always matched up against all these currencies. If the US dollar is up, then gold has to come down, because gold is priced in US dollars, and gold has this inverse relationship that is built into gold, and therefore it will come down. Oil may come down, generally should come down, but oil dances to other tunes as well, and so it may or may not come down. But in general, if you just look at the US dollar, if the US dollar is going up nicely, the oil should be down. If the US dollar is down, then it's the opposite. Euro, others go up, and gold, oil generally would go up. When stocks are up, then we are talking about a risk on trade. So when stocks are up, when sentiment is bullish, we are talking of a risk on. So that means people are willing to take risks at that time. So it must be a bullish environment. And if stocks are up, then bonds should be down. Australian dollar will go up and Canadian dollar will go up. Why? Because these are the risk on currencies. They are very heavily commodity based. So whenever stocks are going up and sentiment is nice, that means economy news, whatever it might be, is good, and therefore these commodity countries are going to go up on the assumption that there's going to be more exporting of these commodities. People will have to buy it in Australian dollars or Canadian dollars, and therefore the demand for that currency is going to go up. But if bonds are up, then stocks must be down, although that correlationship has not worked out because of market intervention. When stocks are down, that means it's a risk-off mode, and therefore bonds will be up, gold might be up, US dollar might be up, all the safe haven currencies might be up. When crisis risk is high, that means stocks will be down. Whenever there is any kind of unrest or crisis or geopolitical event or terrorism or whatever, stocks are the first thing that take a beating because they are the most riskiest assets. And so people dump that without even thinking. So that means it's risk off. And so crisis risk is high. You'll have all your safe haven trades going on at that time. Global GDP is high or good is the same as stocks, commodities, everything is up, risk on, bonds are down. If interest rates go up, and in bracket I have down, so let's look at that entire line that way. If interest rates go up, then money flows into the country because big institutional investors want to take advantage of that 0.25% or 0.5% because if they put in $100-200 million, that 0.25% or 0.5% makes quite a bit of money. And so money flows into the country if interest rates are up. And when money flows into the country, that means the local currency value is going up because people have to convert their money into the local currency before putting it in the local market there. And therefore that creates a demand for the local currency and the local currency rises in value. Similarly, if interest rates go down, then money flows out of the country and the local currency will go down. Global stability up, stocks are up, bonds may be down, risk on trade. So all the safe havens are down and you have all the risk on trades will be up. When money printing is going on, stocks will be up. US dollar should generally be down, assuming the money we're talking about is US dollars. Inflation should generally go up because this extra money is coming into the market. And gold will go up because gold goes against the US dollar. And therefore, when the US dollar is going down, then gold will go up. So that's kind of this macro relationship we have in this world between some of these assets and some of these countries in particular. A lot of these correlationships work at any given time, but there can be breakdowns, and that's the problem. So you will see breakdowns, and those breakdowns should give you some additional thinking material as to, okay, why is this breaking down? Do we need to follow this? And that's when you want to catch some little pieces of news or TV nuggets to see if anybody else is talking about this, because that can give you insight into the markets. So anyway, that was on macro correlationships. Here's a trade recap that we did, all the trades, and some of them are not complete. The final results, I'll probably post it as an announcement on the course page itself. So we had some very good trades. Obviously, booked all our winners. That was good. Google was a put option trade, made 4,300. In terms of percentage, that was a 30%. It is the British pound. So that's a Forex ETF put. And we made about 30% on that, $900. /ES, the S&P futures. So asset type was futures, $1,500, 15%. Apple was just plain stock, $300, 3%. Euro USD pair, that was a spot Forex trade, a very small trade. We made $75, but that was 33% of our capital. And the Euro futures trade, we made about $500, 15%. Let's go take a look at what open positions we have, and I'll tell you the plan for each of them. I don't want to close the trade just because the course is closing, but I'll put it up as an announcement, I suppose, on the course page. But let's go take a look at what's going on here. So as of now, Chipotle is down 5,000 on a capital of 50, so about 10% down. It was meant to be a very long-term trade. Now, obviously, I may not hold it for that long, but I'm going to hold it for now. And you can see that once we put in the short, you can see now the short is making money. So even though our long call is losing money, but right now it's actually a hedge. And so that's what I was hoping for. Gold is also down. I'm going to hold it and see for another couple of days. Price line seems to have come down a bit today, but we are still in profit on price line. I think I might just take it off. It's not a great profit, but there's just been so much up and down movement with Priceline that I feel we had some good chances and we didn't take it. So now let's just close that out. So that is about what, $100 profit, not a whole lot. And XLF as well, I just want to take it off because it just doesn't, it's not moving too much. All right, so that was a flat trade. So I'm going to watch CMG, I'm going to watch gold and TLT. So let's go here and see what it is. XLF, I would say this is a financial ETF. I'll just say flat. And same in Priceline. I think I'm missing one. Gold, perhaps, I think. Yeah, GLD. I'm missing one on this. I'll add that later. So these three positions I'll continue to manage and give some updates at some point. So what is your goal with these positions? So for me, if I can come back to break even on these positions, I'm perfectly happy, right? Because then you've managed your losers and then your winners will come. So statistically, if you can win about 7 to 8 investments that you make out of 10 and manage the losers, don't let the losers run away. That's the key. Okay, so that's the end of this lecture. Let's look at the final conclusion and wrap up and all of that in the next one. Thanks.